Good morning, everybody. Hey, welcome to Wednesday, halfway through the week. It is November 10th. And hey, yesterday was, well, we'll talk about it more in a minute, but it was a give back day. A lot of giving back on all the indexes. We do have some major economic stuff coming out today. The Thursday reports will be coming out this morning. Jobs and unemployment and some of those type of things. Core CPI comes out. All important things that we need to talk about this morning when Dave joins us here in just a moment. But before we do, please let me remind you that as you get closer and closer to retirement, if you're 55, 60, or already in retirement, you need to have a plan in place for where your income is going to come from. We have put together our process of core retirement design, trademarked, because we put so much time and effort into it, and it works to help create the retirement you always dreamed of. We put together our core retirement design. Give us a call, 863-382-0037. And with that, we've got Dave coming up next.
Pink there, 105.7 Light FM. I'm at 8:40 now, 20 before 9. And it's time to check in on your money on Wall Street. And I've been kind of happy and kind of smiley for the last few days going into this. If you detect a certain fall in my voice, well, there's a reason. Got a bunch of economic junk that came out that's not making the markets very happy this morning. Let's go check in with Philip Statler from Statler Financial Services and see whether he's jumping off a roof yet. And Philip, good morning. How are you?
Hey, you know, when you have good days, you got to expect some tough days too. And
kind of the way this one starts to be working out. We were down a little yesterday, but not really that exciting. I mean, 112 points against the 36,000 Dow really isn't all that much. 1/3% swing on the two blue chip indexes yesterday, both downward. NASDAQ down a little over 0.5%, but it was one of those just, maybe just profit-taking days yesterday. Then we come up to the macro reports for this morning, and holy crud, there isn't one bit of good news we got out of this, is there?
No, there's really not, Dave, as we continue to look at what's happening in the world around us. These numbers are just not good. I don't know which ones you want to start with first, because there's a bunch.
Oh yeah, well, let's start out with the minor misses that you shrug your shoulder at. We got the initial jobless claims and continuing claims out this morning because tomorrow is Veterans Day. Expected 260,000 first-time unemployment claims came in at 267. Yeah, small miss. Continuing claims they expected 2.050 million. We got 2.16 million. Small miss. And again, because it's early, we aren't even sure of the survey. But then we get to the consumer price index. Month over month, our market basket prices went up by 0.9%, almost a full percent in 1 month. Now, those of us that do our own grocery shopping are kind of saying big news on that, but when you get it out of the federal government, you kind of sit back on your heels, don't you?
Yeah, you really do. I mean, that is a huge deal. I mean, I will say it's not a big miss in terms of what was expected, because they expected on the CPI, they expected 0.6. It came in at 0.9. But what I look at is month over month. So if we look at September, the CPI was up 0.4%. So we more than doubled it this month from last month. And the core CPI, again, expectation to what it is, not too bad. It was expected at 0.4, came in at 6. But I look at last month, it was 0.2. So we tripled that increase. That's what I look at. And that's some big increases. As a matter of fact, one of the headlines I saw said that, that this is the biggest increase since, get this, Dave, December of 1990.
Crap. That's back when we were kids. It's not good news. I mean, that equates to a 6.2% annualized inflation rate. And I mean, Social Security recipients last month said, 5% rise in my Social Security benefits. That's fine. Well, we're already pretty well whacked that down to nothing, haven't we?
Yeah, we have. I mean, it sounded good until you start looking at all these other numbers and think, well, geez, that's not going to keep up with inflation.
Yeah, it's not. And the core, you can write it off. Normally we'd say, well, gas prices are up. What do you expect? But that core number excludes food and energy. And that means all the stuff that is normally relatively stable on price and isn't subject to wild fluctuations, that gives us a 4.6% core annual rate. That means the stuff that pretty much stays put is also going up at close to 5% inflation. Kind of something that I seem to remember over a year ago, you and I were saying something like this was likely to happen, didn't we?
We did. Maybe we could get in the forecasting business, Dave.
Offhand, I think we might be able to make some money doing that because by and large, bottom line is inflation, and somebody got to take notice of that in Congress while they're talking about that extra $1.75 trillion they want to spend now.
Yeah, Dave, unfortunately, I don't think they are. I think they're going to just, sweep this number under the rug and just keep on trucking, spending money. I had an interesting conversation last night with a economics teacher and at my Kiwanis meeting. And I found it interesting because she pointed out, and I hadn't really thought of this, but she was absolutely right. We could nip this stuff in the bud really quick, Dave. Mm-hmm. All we have to do is quit spending money.
No, that's too easy. Can't work.
Don't go buy the new car. Don't go buy as much in groceries. Pay, get the bare minimum. Don't go out and buy the new house. Don't just quit buying stuff. Just the bare essentials, and that would get people's attention because if you're not there to buy it, well, then they have to lower the price to entice you to buy it. And so, yep. I thought that's a pretty easy fix.
Yeah, the only downside to doing that from the consumer up ends up putting the local mom and pop retailer down before it has any chance of changing the national economy. But your point is very well taken. At the very least, as far as the big stores, the corporate-owned stores and whatnot, going and just simply increasing our savings rate would be good for us individually, and it'd help the economy as a whole. I would never advocate just choking off money on the mom and pop stores, though.
Well, that's true. I mean, you don't want to do that, but it's but anything you can keep from buying, if we could do that unilaterally, that would put pressure, and inflation would not be able to continue to increase because people got to sell their goods.
It is. So the fact of the matter, folks, don't think about, because we talk about inflation being a function of government spending and all of that, but everything turns on that old supply and demand number, and inflation is going up because of challenges and because a surplus of money on the marketplace is making it easier to support those higher prices, and then it just goes around and again because the prices go up, wages go up, that creates more money, and that creates more demand, and that ends up creating more prices. It's a vicious circle once it gets started, and it's caused by stagflation, that term that we kind of dragged back out of the early 80s. It's a real hard thing to stop, too.
It really is. Once it gets to cranking, it just, like we said yesterday, it's almost like a snowball rolling downhill. It just keeps getting bigger and bigger and bigger.
And I don't want to think about how we solved the 1970s and early 80s stagflation problem. Remember what happened?
That was not pretty.
It was a very deep, albeit a very short recession, and that kind of flushed the commode, and it brought us back to a more planned growth rate, and that's not the solution we're looking for. So actually, your econ teacher's idea, with the exception of not stopping spending money in the mom and pop stores, might not be a bad idea.
That's right. Hey, but it takes a concerted effort among everybody to do that, right? If just a few people do it, it's not going to work. It takes everybody doing the same thing.
It really is. That's absolutely sure. So bottom line is the reaction of the markets was profoundly negative. That you and I were comparing notes, your instant tick number to the delayed quotes. The losses on the market pretty much doubled between 8:27, 3 minutes before the numbers came out, and 8:35 at the time that we spoke. And there's been another side effect, too, the reaction in the federal bond market. Yields are going up on federal bonds, which also messes with the stock market.
That's right, and it does mess with the stock market, especially the Nasdaq stocks, because they're a little bit more interest rate sensitive than the rest of them mainline companies. So that's also adding some fuel to the fire.
Yeah, in other words, it's probably not going to be a particularly good day today on Wall Street, and we're going to cross our fingers that tomorrow it'll turn into a maybe we overreacted day and a little bit of a bounce back. How are the companies doing that are reporting for earnings season? Have we got any good news on them?
Dave, I wish I could say I did, but everything I see is taking it on the chin. Let's start with Coinbase. Coinbase was that company that was a cryptocurrency exchange. I think they went public. It was this year, I think, wasn't it, Dave?
It seems to me, yeah, they were one of the early ones in terms of being able to buy crypto online, and I think I remember their IPO about 6 months ago.
So they missed on revenue by about $250 million.
Is that all?
Yeah, that's all. Their monthly transacting users declined from the previous quarter. So they're just like I said, they're taking it on the chin. They're trading down today almost 10%.
I got to believe some of that is the advent of those ETFs that are trading in Bitcoin. That's a little bit safer way to mess around on the Bitcoin markets. All of a sudden, buying it on your cell phone doesn't sound as secure as going to your broker and buying an exchange-traded fund working on them.
Well, that's true. You're absolutely right. There's more options now, and so that could be putting some pressure on them as well. The price is getting higher, so less people can actually want to buy it now because it is high. They think it'll come back down before they buy. So a lot of things there. The other one we have is Poshmark. I had to figure out what Poshmark was because I couldn't remember, but it is a site where you can buy and sell secondhand items, if you will.
The snobby stuff, I'm assuming by the name.
I would think so. I think it's probably got to be good stuff, But they lost 9 cents a share on revenue of about $79 million. The Wall Street was expecting a loss of about 7 cents a share on revenue of $82 million. So a miss there on both the top and bottom line. And they came out with weaker than expected forecast. You know what that means, Dave. That is the recipe for not good. Down 32.5% this morning.
Holy crud, they got to be our big percentage loser of the day, don't they?
I think so. I think so, though. Yeah, that is the big loser, at least what I have today. Everybody's down today, but they're the big loser for the day. We had Fubo TV. They're the ones that kind of specialize in sports streaming, live television. They had weaker than expected results as well. They lost 74 cents a share. They're expected to lose 63 cents, so that's 11 cents worse. In terms of revenue, they missed by about $13 million. So nothing to really laugh at, but it's down about a little over 9% this morning.
Well, it's not a fun day to start it out. Resetting the table, it was kind of a leveling off profit-taking day yesterday. Red ink, but not a monster amount. Things are going to turn a little bit this morning toward the negative side 45 minutes before we open. Philip, what do things look like?
Well, they have, I will say, they've improved a tad, not a lot, but we got the Dow actually down almost 0.2% right now. That's almost $65. The S&P 500 down 0.33% or $16. The Nasdaq down 0.75%, about $106. So everything is looking red this morning on the index side. Commodities, we got a lot of green ink today. Silver up 1.1%. Gold up almost 1% to $1,848 an ounce. And then the green you don't like, crude oil, a massive increase from yesterday when we talked, up about 0.25% right now to $84.33 a barrel.
Wow. And those changes in gold and crude oil are all inside the last half hour, because a half an hour ago, my quote had gold down a little bit and crude oil only at 83.5.
There you go.
Things moving fast. Overseas markets, Asian Rim was mixed. No big movements either direction, although the Hong Kong day had a 74/100% increase. Europe is kind of looking at our futures market and our economic reports and going, ugh. So they're all just slightly to the negative as well halfway through their day. This is one of those poster child moments, Philip. You can control your own investments. You can't control the risk because, well, heck, the government vomits up numbers and everything goes in the wrong direction. That takes controlling risk. How do I find you to do that to my portfolio?
Dave, the closer folks get to retirement, the more important it is to have a plan in place. We want to help folks really and truly design the retirement they always dreamed of. And we do that through our core retirement design process. Give us a call at 863-382-0037 to schedule your visit. And then check out our website, statlerfinancial.com. Join us on Facebook at Statler Financial Services. And then this weekend, the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and now on 95.3 FM.
And it does look like we have a noon start to the Gator game on Saturday, so it looks like we're going to miss the Saturday run, but 6 a.m. Saturday morning and 10 o'clock Sunday morning on News Talk 730. Fair enough?
Fair enough, man.
Thank you, my friend. I will see you tomorrow.
All right, buddy. You have a great day.
Be well. It's 105.7 Light FM and Statler Financial Services. Philip Statler from the pitch. Swung at the lip.
Hey, folks, again, I want to thank you for joining us today as we hit the middle of the week. Hope you'll join us again tomorrow. Until then, take care.